Welcome to Beers with Rich. I'm Rich, editor of Under the Radar Report. It's great to be back once again. I'm not taking any chances amid this crazy market craziness. I'm going back in black. Black Hops Brewing, G.O.A.T, hazy IPA. Well, no prizes for thinking this Queensland-based brewery has tickets on itself. Let's see if it measures up in this pretty slick label. Crack it! Smooth. Similar to last week's. Slightly smoother. Black Hops beer. Black Hops down. Good film, that. The first thing to toast is our portfolio manager, our own portfolio manager, the idle speculator. Put his money where his mouth is. Told me he spent more on buying stocks the other day than in the entire prior 12 months. So here's to you, Mr. Idle Speculator. So one of those stocks could well have been the software turnaround we commenced coverage on this week. A very exciting stock, New Zealand-based stock. I really enjoyed researching that one, actually, and high hopes. But this week I want to talk about the banks, because many of you will own one or two. So it's particularly relevant when there's carnage, particularly in that sector. But before I talk about the banks, let's talk about what our portfolio manager is doing buying stocks. What he's doing can be summarized in two words: indiscriminate selling, because that's what's happening. Look, it's a bloodbath on global equity markets. We all know the driver. You know, the bogeyman of inflation causing rising interest rates. But you know it's indiscriminate when stocks that actually benefit from rising interest rates are being sold out like the baby with the bathwater. Turfed out, I'm talking about insurance stocks, I'm talking about Computershare. Yep, those stocks that are forced to hold bucket loads of cash, even those are being dumped. I mean, that says all you need to know. And yes, the banks too. CBA, ANZ, Westpac and NAB. Okay, so we know about interest rates, but what's forgotten, I think, in a lot of the commentary amid the hysteria is the big leverage in the US market from brokers like, discount brokers like Robinhood that don't actually charge brokerage, lending on margin on for crypto assets. So basically I'm talking about people getting 20 to 1 leverage. So for 5% of equity, you can get 95% or more dosh to pump with. I mean, these people get a crypto account, they get a stock account. So what happens when the crypto wipes out your equity? Well, you have to dive into your stock account to replenish it. So that's right, we're talking about forced selling, which is what happened in the financial crisis, where lots of people, lots of institutions used the stock market to raise cash because that was the only liquid market. So the point to make is, amid all this carnage, is that the companies haven't changed. The companies we still like are the same companies we liked before. What's changing right now is what investors are willing to pay for those companies, what they're willing to pay for future cash flows. So what's happening basically from valuation principles is there's a ratcheting up of the equity risk premium. So people might pay only PEs of 12 to 15 times, whereas before, when there's zero interest rates, they paid 20. So you've also got that risk-free rate going through the roof on top of this. So we're talking about I can't think of a time where there's been this steep a climb in interest rates. The US Treasury bonds have gone from 1.5% 6 months ago to 3.3%. So this rate of change is almost unprecedented in the giant bonds market. So that's what we're talking about here, increasing discount rates, which means a depressed effect on valuations. That's the denominator. On the numerator, you have those future cash flows, which is where fundamental analysis comes in. So what do we like? Cash! We love cash. Dividends. Well, that's what being a value investor is about. We also love growth, but we don't want to pay much for it. So the banks, are being sold off because people are fearing that they're ex-growth. People are nervous about lending. So basically, this provides an opportunity because they're going through, these banks are going through a period where their margins are actually forecast to increase. So they benefit on the income side from increased overnight interest rates. On the cost side, they benefit from a rolling off of those pesky low margin fixed rate mortgages. So you might ask about defaults. Australia has a high savings rate, or a higher savings rate than previously. Our economy is still rebounding from the recession, and the banks have very strong balance sheets. This is contrasted to the basket case in the BNPL space, but that's another story. So what's our favourite bank? Our favourite bank's ANZ. Why? Because it actually has the lowest return on equity. So that means that when these improvements come through to the bottom line, that translates to greater leverage for shareholders. That translates to increasing returns. So what you can do is extrapolate like what I'm saying there into small caps. So obviously, if you're investing in small caps that are, have really strong earnings, that have defensive earnings, that can improve their earnings no matter what the conditions, when things improve, their return on equity effect is magnified. And this drives big value appreciation. Here's the value appreciation. I mean, it might not be one stock, it might be two stocks. But if you start investing in a portfolio of 5-6 stocks, one of them is likely to take off. That's what we're talking about right now. That's excitement that's on the table. Next cab off the rank, Westpac, followed by NAB on the valuation stakes, according to our model. We upgraded NAB this week because its stock really is quality. And that's what you can get at times of indiscriminate selling. Quality at value prices. What's coming up? Well, let's just have a sip of that G.O.A.T beer. Well, it's growing, mummy. Could well be the greatest of all time. I don't know. Depends on how the Blues go in the next Origin match, obviously. I'm not sure whether if they go well, it means it's the greatest or not, being a Queensland beer. But anyway. Next week, we're coming up with 5 stocks that have outstanding fundamentals but have been beaten down. So baby out with the bathwater stuff in the small caps sphere. So these are stocks you can go to sleep with. Not literally. Who would want to do that? But literally, you can have a good night's sleep owning stocks. They're going to be there tomorrow. They're going to be there next week. They're going to be there in 5 years' time. These are the types of stocks that just by virtue of that compounding effect on the return of equity are going to make a lot of money, which is the most important thing, because when you're paying not much, your upside potential is that much more. Here's to Beers with Rich, and see you next week.